Phil Chronican, thank you very much for joining us. Now, a 14% drop in your statutory profit, below market expectations, a double whammy really of remediation and these low interest rates.
Look, it's been a very difficult year, as I think everyone understands, both for the industry but also for NAB in particular.
Yeah, this is the third bank result.
Indeed, and we've taken over $2 billion worth of remediation charges this year, and we're having to deal in a very low interest rate environment, and that has negative impact on bank profits.
A 16% cut in your full year dividend. Now, you talked also about cycles, but for shareholders, so much of this now must seem structural. The days of high fees in wealth are over. You've got new capital requirements. I mean, shareholders should never expect a return to 100% payout, should they?
Well, I think the structure of banking is changing, and we need to adapt our businesses around that. So we've had to obviously reduce the dividend, which I appreciate is quite disappointing to a number of our shareholders, but we need to get it to a level that's sustainable so that we can make sure we can be clear with our shareholders the level of income they can expect from a bank share, and make sure that we retain enough earnings to be able to deal with the issues that we have to deal with.
Now, having said that, Phil, I think your shares are actually up, and that's probably partly about your cost management and what you think your costs are going to be going forward. Performance-wise, is NAB over the worst? Have you reset the slate for the new incoming CEO, Ross McEwan?
Well, we've certainly tried to. I don't want to declare complete victory, because there's always issues to deal with in any large business. But we've made a point this year of wanting to address all of the issues of the past and make sure that we're addressing the future. And clearly, with Ross McEwan coming in here in the beginning of December as our new CEO, we want to give him as clear a start as we can and give him the opportunity to help build NAB back into the bank that we think it should be.
You yourself are moving from CEO to chair. You're heading into an AGM. Now, last year, the first strike against the board's remuneration report was the largest protest ever.
Yes.
Protest vote ever for a big business. Are you confident that there won't be a second strike?
Well, that'll be up to the shareholders. They're the ones who get to exercise their vote. All I can say is that we've done everything we can to make sure that we are transparent with our shareholders and are managing the bank as professionally as we can. And what that's meant is that we've made changes to the remuneration scheme, because that was one of the factors last year. Last year there was concern that we'd not listened enough to the shareholders about the amount that we paid to executives.
So what have you done for bonuses and that sort of thing?
So two things. We've, for some of those people last year, we've actually taken back some of the deferred compensation that was awarded last year. And in addition to that, this year there'll be zero in terms of short-term variable reward for the senior leadership. You
are the business bank. The business bank is your biggest division. Yes. You've had growth, and you've said there is growth to be had, indeed, in small and medium enterprises. But you've also talked about the challenges. What are the challenges? Is it the confidence out there in small business, or is it more the regulation?
Look, it's a combination, because I think the policy uncertainty, some of the macroeconomic concerns, but also regulation, both on businesses and on banks, are what's holding back business investment. And what we've been saying is that low interest rates have done as much as they can do. We need to look at what are the other issues that are holding businesses back from investing.
Yeah,
and we're very much aligned around that.
You've actually said that even government fiscal stimulus is all very well, but actually, even, for example, your own new banking code and the government's responsible lending laws are really providing problems.
Well, we're talking about those things that are putting, I guess, slowing the process down. And there's been a lot of regulatory change over the last couple of years. Much of it's well-intended, and I'm not arguing with what's being sought to be achieved, but it's added a lot of process steps, it's added a lot of compliance activity, and that has made it harder for us to get loans into the hands of our customers.
So what needs to change?
But also, can I just go on and say one other thing, which is our business customers themselves, they're looking at the regulations that affect them, and they're looking at the policy settings that affect them, and they're uncertain. So what we're talking about today is we want to get behind our customers and help them address what are the issues that are stopping them investing, and then look at our issues and say, well, what can we do to be better at meeting their needs by providing credit support? So it's twofold.
Is it the fact that they find it hard to use the house, or in terms of borrowing, or is it the fact that they're not judged on their cash flow and their income can be very lumpy? What is the problem?
So there are issues. I mean, the Code of Practice puts a whole lot of additional steps in when people give guarantees, and a lot of businesses, as you'd appreciate, take director guarantees or family guarantees. That process is now more complex. Yes, when you put up the house for a small business loan, you've got to look at the responsible lending obligations that go with that, so that's slowed the process down. But as I said, it's also about making sure our businesses are confident to want to borrow in the first place, and making sure we can help them drive the demand for borrowing as well as the supply.
On the consumer banking side, your mortgage growth was quite disappointing,
yes.
But you're expecting better, are you?
Yes, we had a good first half. We had a weak second half. In fact, the home loans book went backwards in the second half. But towards the end of the second half, we had some good positive momentum. So we've been looking again at all of the things that get in the way of our people supporting customers who want to borrow to buy a house and trying to make that work. So in the last few weeks of the year, coming into October, we've had some pretty good weeks in terms of new lending, but we've got to wait and see that flow through the book.
Now, obviously, there have been 3 rate cuts this year. I think they've cost you $200 million around about. How is your message on why you, a big bank, can't pass on the full cut being received out there?
I think we've had this debate in the public for a long time, but obviously as interest rates come down, there's a limit to how much we can reduce deposit interest rates. So we reduce the rates to our borrowers, but we can't reduce the rates to depositors because in many cases the rates are already very low, and there's no real basis for taking them below zero.
Do you think the message is getting through?
Well, I don't know, but the more opportunity I have to pass it out, the more it's there. So even though, in the eyes of some people, when we didn't flow through a whole 25 basis point rate reduction, they think that we're holding it for ourselves. Actually, we're losing as well. Our shareholders lose money out of that equation. Because we're putting real pressure on the deposit book. So bank profitability is challenged in a low-rate environment.
Phil, your other challenge is obviously the amount of capital that you're being asked to hold. Now, on the Australian side, you've got your dividend reinvestment plan you've announced today. Some people were expecting you to raise capital, but it looks like you're going to be able to achieve above the 10.5 going forward. Yeah,
so we ended the year just below 10.4. With the dividend reinvestment plan and the underwriting of that today, that'll take us, once that's complete in the next month or so, that'll take us to about 10.75, so well ahead of the 10.5 that APRA was requiring.
Now, what are you going to do, depending upon what the New Zealand regulator, who obviously feels that they don't trust Australia to bail them out in a crisis, they want potentially much more strict capital requirements and, in fact, other requirements of you. What are you going to do?
So the other requirements are to operate the organisation so that it can be separated and run standalone. So we've got that in train. We're planning to meet the requirements there. The consultation that they put out on capital was to have a significant increase in capital for banking in New Zealand, and that's been a consultation, and we're expecting them to respond to all the feedback they've had in December. We don't know where that'll land.
Lowering investment in New Zealand, you've basically said today, haven't
well,
you?
I think what we have to understand here is that if you, as their initial proposal put it, if you double the amount of capital required to support banking in New Zealand, then actually there'll be less of it. It won't be just us lowering our investment. There'll be less demand for credit in New Zealand. So we need to look at how that would play out. But the Reserve Bank of New Zealand has been open to conversations around over what time frame these issues might be phased in, what instruments might apply. So I think it's a little stark just to say that capital is going to suddenly double. That's not the way I think that they are envisaging this happening.
Could you see a scenario ever where you actually sold the Bank of New Zealand to the Kiwi Bank?
I'm not sure Kiwi Bank has enough money at the moment themselves, but look, I don't think that's a realistic prospect. The Bank of New Zealand, as you should have seen in the result, actually the Bank of New Zealand has been a very solid performer for us. Right. So despite all of the issues in New Zealand, actually those businesses are our business anyway is growing and it's profitable. So we like that business a lot.
Phil Chronican, thank you so much for your time.
Thanks, Tikki.